Welcome to the Market Mosaic, where every week we are breaking down the intersection of macroeconomic data, stock market technicals, and market internals. Things like breadth and sentiment. Try to figure out where the market could be headed over the near term to break down some of the major catalysts that could impact investors. And we've had some absolutely huge developments over the weekend. So, fears had been building that a growing U.S. military presence in the Middle East meant an imminent strike on Iran was coming, and that's exactly what happened over the weekend. A series of attacks took out key Iranian leadership, and now we're seeing retaliatory strikes against U.S. targets and its allies all over the Middle East. This is still a very fluid situation. It's still ongoing. While events and reactions again, while these things are unfolding, there's several areas of the markets we can look to for some big repercussions. I think for investors, the primary focus of the conflict in Iran has been how the stock market will respond to the hostilities. And while the immediate reaction we saw in stock index futures and as we saw in the market open on Monday, that reaction has been to pressure stock prices. We've seen a downward move, but that's already starting to be recovered a little bit. And that's because military conflicts historically tended to see stock prices higher in their aftermath. There's a war, unfortunately, is also can be very stimulative for the economy, and you see that reflected in stock prices on here. So, this takes some select military conflicts going back to World War II, and on these key dates, what the market did the following day, which, as you can see, the immediate reaction is for stocks to sell off. We're seeing that. But on average, in the aftermath, a month later, 3 months later, 6 months later, the S&P 500 has recovered. So again, while there's a lot of, which is natural to be expected, a lot of fear around these events unfolding, once you get past the initial reaction, the market, tends to rally on average. And you can see it's a pretty high win rate across those periods when you look out 1, 3, 6 months as well. So, I think you don't need to really focus on or fear the action in the stock market. I think the bigger risk for investors is the impact on oil prices and what that means for the inflation outlook. That's because the Strait of Hormuz off Iran's coast, it sees more than 14 million barrels of oil pass through. That's about a third of global exports. And, so that's emerging as a choke point. Traffic through the strait has slowed. So we're seeing oil spike higher, but we're also that comes at a time when we're seeing a rally in other commodity prices as well, like copper. And all these things coming together should present upward pressure on headline inflation. Now remember, we're already seeing the Federal Reserve make this hawkish pivot to where they're starting to entertain the idea of rate hikes instead of rate cuts. So even before the weekend's events, recall the producer price index that came out last week. It was reported at 2.9%, a 2.9% gain in January compared to last year, which doesn't sound too terrible, but the core figure that excludes food and energy jumped by 3.6%, and that was well ahead of estimates for a 3% gain. And why is that important? It's because PPI tends to lead changes in consumer inflation. We're already seeing an uptick, a strong uptick in core PPI, and that's before any impact of this weekend's events, and especially what we're seeing in oil markets is felt in those inflation reports. So this week, I want to look at the breakout in oil prices that could be underway, what that means for inflation, the outlook for rate cuts. I also want to look at the evidence that inflation risks are already building, and key level we need to watch on the U.S. dollar because this could impact a number of markets. All right, so this the ongoing conflict in the Middle East. We're seeing a significant disruption to global energy exports. Reports, suggest that tanker activity going through the Strait of Hormuz has slowed to a crawl. Numerous ships have come under attack, and it's having a big impact on oil prices. So oil's already been steadily rising since December on these rising fears that the U.S. was going to launch a military strike against Iran, and it brought oil to a key level. Now, this chart's not showing the price action after the weekend's events because I want to highlight this level on here. And what the chart shows that oil's been in a primary downtrend since late 2023. So going back to late 2023, we've had lower highs and lower lows along the way. So that's the primary downtrend that I'm speaking of. But this recent rally we've seen since December has brought oil right back to this downtrend line. And now what we're seeing this morning is that oil is breaking above, this week oil is breaking above this trend line. So we could be seeing a very, very significant major breakout in oil prices that are underway, and that has some really big implications for the inflation outlook. That's because changing energy prices can drive fluctuations in headline inflation. Now, a study by the Federal Reserve estimates that every $10 increase in the price, $10 per barrel increase in the price of oil adds 0.2% to headline inflation. And this chart comes from their study, their report, where they looked at this period back here where you had Brent crude prices, which is a good global benchmark for crude. You had this spike coming out of the pandemic and into mid 2022 that we had this major uptick after Russia launched its invasion of Ukraine. And you look over to headline CPI, the Consumer Price Index, and what that did during this period of rising oil prices. Now you can see the energy component of headline CPI. These red bars were a major contributor, but you saw the core and food categories being pulled up higher here as well. So energy was a major contributor to the last inflation wave that peaked in mid 2022. That sent inflation, CPI was at the highest level in over 40 years. And so, we need to keep a close eye on if oil sustains these gains, this major breakout from a downtrend line that's underway. This is a major warning on the inflation outlook. All right, so the conflict in the Middle East, that's obviously a major catalyst right now for the movement in energy prices, but a prolonged period of underinvestment in various energy and industrial commodities was already setting the stage for a rally. And so what this chart does is it tracks a ratio of capital expenditures to assets across these various commodity categories. And what you'll notice is that, this goes all the way back to early 1980s. Look more recently, you'll notice a sharp drop in these ratios starting around 2013. And so what this means, you get below the zero line, this is a z-score, but below the zero line means that capital expenditures, CapEx relative to assets, is running below the historical average. So we dropped sharply below the average, and we've stayed there since then, in everything from metals to oil and agriculture. So structural commodity deficits, we're already seeing these emerge in areas like copper. And it could just be the start. This could persist for an extended period of time, where this deficit, potential deficit in commodity supplies, could be around for quite some time because of how much money and time it can take to bring new supplies online. So even before this weekend's events and this impact that we're seeing on the energy markets and how that could impact inflation, there is already a hawkish shift underway at the Fed. We already know there's intense political pressure on the Fed to lower interest rates, but the minutes from the most recent rate-setting meeting at the end of January showed that several Fed officials are now talking about the idea of hiking rates if progress on lowering inflation continues to stall out. So inflationary pressures remain. Key core categories of consumer inflation are still running at high levels. Super core inflation in the CPI report ticked up in the most recent data, but then leading indicators of inflation are sending a warning as well, and that includes the producer price index. This blue line on here is a year-over-year change in the producer price index. The headline number increased by 2.9%, but the core figure that excludes food and energy came in at 3.6%. That was well ahead of estimates for 3%. So that's what this blue line on here is, core PPI. And what it does is it overlays core PPI with core CPI, consumer inflation. That's the dash line on here. And you can see, when you look back, core PPI can lead, these changes in CPI. This is inflection lower into 2020, and then how we turned higher coming out of the pandemic. Core PPI peaked well ahead of CPI and started moving lower. Now we've had this bump higher since early 2024. That's looking like it might be accelerating once again. So if we continue to see this core PPI accelerating, that's a big warning signal on the outlook for consumer inflation. All right, so investor intention right now, all eyes are on what's happening in energy markets, what's happening in the stock market, but don't lose sight of what's happening with the US dollar. So the US dollar index is what's being shown on this chart. EXY, it rallied from, we had this failed breakdown at this 96 level. Why is this level important? because we tested it on a couple other occasions back in 2025, following this sharp decline in the dollar up until about the midpoint of that year. Came back, tested that level a couple times, tried to break through, and then had a sharp reversal higher. But look at where we are right now. So the dollar, the XY is struggling around the 50-day moving average. That's the black line on here. If you kind of look at this as a pattern, I mean, it's almost presents as a bearish flag pattern on this rally off the 96 level. And we're also getting the MACD having this bearish reset in momentum at the zero line, below the zero line. So what we want to watch is if these things line up to reject DXY back lower, we'll watch and see if that 96 level comes into play again. But if we were to actually take out the $96 level this time, the 96 level on DXY, a new low in the dollar would be another big tail end for the moves that we're seeing in commodities and precious metals, and a weakening dollar could also add another risk to the inflation outlook. All right, so while this weekend's events in the Middle East are going to be dominating the headlines, we have a very important week for economic data. A couple things you want to keep an eye on is the ISM is releasing their PMIs for the manufacturing and services sector. The two things I would keep an eye on within these reports, one is the headline figure above or below 50. Above 50 means expanding activity, below 50 is contracting activity. But within these reports, watch the prices paid component, which is often leads inflation, and also watch the new orders component. The new orders component tends to be a leading indicator for the economy. The other big data release we'll get this week is non-farm payroll. So we had a strong, much stronger than expected number in January. The February figure right now, the estimate is for 58,000. If we see another consecutive month of stronger than expected payrolls, I think you really see the Fed start to shift their focus to what's happening in inflation away from worries over the labor market. All right, one trade idea I want to keep an eye on this week is with Energy Fuels, ticker UUUU. Exposure to uranium as well as developing rare earths capabilities as well. So there are a number of key markets that they have exposure to. So there's the thematic tail end is there for the name. Now on the chart, what I want to watch is we came up to test. We kind of peaked out most recently around this $25 level. This happened back in October. Here's your larger pullback, rally right back toward that level, and now we're getting a smaller pullback. We want to track these smaller pullbacks suggest accumulation in the shares. If we can see now the stock stabilize and turn back up toward that $25 level. We've had this bullish momentum reset in the MACD, and the RS line is holding near the high. So another, these are good signs for momentum. So we want to watch for a breakout on rising volume over that $25 level. All right, that is all